Nitish, I would like to know what is the basic difference between a venture capitalist and an angel investor.
Angel investor is someone who invests his own money, and a venture capital is someone who invests someone else's money. So let's say you want to become a VC, right? How do you go on about raising money for your fund? So that is the most difficult part.
How should a pitch deck be, and what are the common mistakes that a startup founder that you meet in day to day is making a mistake in the pitch deck?
A lot of people, a lot of early stage startups, the mistake that they do is they try to cram in as much information as possible into a single deck, right?
In your perspective, how should I find is the product market fit?
Right. The first step you do is look if there are other companies in the market that are doing something similar to what you're doing.
If I'm giving you 1 crore in your hand and you want to invest it in some sector of the company, in what sector are you investing right now?
If you give me 1 crore, first I would focus is in India right now as consumer. A lot of people would be hesitant towards that because build products for the world, right? If you're able to build a product and sell it in India, you can sell it anywhere in the world.
Give me some tips that I take my product worldwide.
See, when you're building a fashion brand, you have to have an identity behind it.
Where do startups fail actually?
Number one reason for failure is founder conflict.
Behind the scenes, what happens to an investor who has invested in the startup?
You're not going to invest like your life savings into a startup. You're probably
So, first of all, welcome to Castle Tapes podcast. I'm really happy to have you today. Basically, in today's episode, we are trying to cover everything from A to Z of investments, who are angel investors, who are VCs, and specifically, I want to make this episode feasible for people who are trying to build a startup from the scratch.
yeah.
So, Nitish, I would like to know something about yourself and the Beej Network, how you got into investments more.
So, hello everyone. I'm Nithish. I'm from Beej Network. So, first of all, let's start with what Beej Network is basically. So, Beej is basically a angel investment network where we enable multiple HNIs, so basically high net worth individuals, to invest in Indian startups. Right. So, let's say you're a startup trying to raise funds, you come to us, and we help you raise funds from investors. So, we are a SEBI registered Cat 1 angel fund. We are a 300 crore fund, and we are actively investing in the Indian startup ecosystem. And me personally, I am the vice president of investments at Beej Network, and I handle everything related to investments and also operations. So yeah, we have been in the market for almost around 1.52 years now. We have made around 23 investments last year. We are sector agnostic. We invest in any sector with a very good idea and an innovative product. And yes, so that is what we have been doing for the past couple of years. And yeah, that is pretty much it.
So, Nitish, I'd like to know what is the basic difference between a venture capitalist and an angel investor.
Got it. Yes. So a venture capitalist and an angel investor. So both are very different people. So to sum it up in a very short definition, I would say that angel investor is someone who invests his own money, and a venture capital is someone who invests someone else's money. So
Okay.
I'll give you a basic definition of how it actually works, right? So let's say you work in a particular company. You're making, let's say, 2 lakhs a month. You're very well off. You're settled in your life. You have all the things you're in a senior management position in your late 30s, 40s, or even 20s nowadays. So you have extra money that you are looking to invest, and you're passionate about a particular startup, or you're passionate about a particular industry. Let's say you work in SaaS, you are a VP in a SaaS company, and you have a disposable income of, let's say, a minimum of 3 or 4 or 5 lakhs, which you can, which you're looking to invest somewhere other than mutual funds or public markets or anything. So there you look out for startups that are quite impressive for you, and that also comes in your expertise. Probably a SaaS startup that is looking to raise funds. and there you would invest your disposable income in this startup, hoping that it would become big, and you also don't mind if that money is not going to come back. You only invest the money that you can afford to lose in this case. So they are ideally angel investors, people who put small amounts of money in very particular startups that they are passionate about personally, and they want to help it grow and they want to see it grow. They are ideally called angel investors. So basically, they are the ones who put the first check. So they are called angels basically. And venture capitalism is a very different space. It is not people who put their own money. So they're ideally like bankers. What they basically do is, let's say I am a venture capitalist. So how do I become a venture capitalist? So there are two things in this space. Two main people. One is called a general partner, and one is called a limited partner. Right? A general partner is someone who is a general partner is the VC. So basically, what a general partner does is he plans to create a venture capital fund. It could be a 100 crore fund, a 300 crore fund, $100 million fund, or $1 billion fund. It can be anything. So what he basically does is he goes around to all these ultra high net worth individuals, our family offices, and he asks them for money. So basically, he tells them, "You give me $10 million. I am going to invest for the next 10 years in this particular industry of startups. Let's say, yeah, SaaS. Again, let's say I'm going to invest in SaaS companies for the next 10 years. I'm going to invest in very early stage companies. You give me $10 million. In 10 years, I will give it back to you as $40 million." So this particular high net worth individual or a family office or any particular institution, let's say there is Google. Google has a lot of profits. They would have money to invest in anything. So they want to increase their investment portfolio also. So probably this person would go to Google, or I'm just saying Google as an example, but there are a lot of endowment funds and everything who gives money. So this person would go and across the world and raise money from these people, and he would, let's say he raises $10 million from 10 people, so it comes around to $100 million. So he would raise $100 million, and he would invest in multiple startups for the next 10 years. So yeah, so this person would ideally invest for the next 10 years. So when you as a startup, you're going and approaching VCs to invest in your company, it's not their money; it's they're putting someone else's money. So their concern would be that, yeah, if I give this particular person $100,000, would he give it to me back as $500,000 in the next 2 years? Because he has to give $30 million to someone else in the next 6 to 7 years, right? So that is his only math that is in his mind. So in this there are people who focus on specific sectors also. So recently, I guess Shikhar Dhawan launched a fund. I'm not sure how big is the fund, but he launched a fund to invest only in sports tech companies. Right. So there
Okay.
are people. So these people who give money to VCs, they would have specific requirements. They would be like, yeah, boss, I want to only invest in companies that are helping sustainability or green tech or electric. Because let's say you are a family office or you are a family business who is into lithium mining, right? And so now if you're giving money to a VC, you would say that, okay, I'll give you $10 million, but I want you to only invest in companies that are working in EV technology or battery recycling or any sort of energy technology, because indirectly that would help your business.
Got it.
Yes, other than the returns, they will also have vested interest sometimes. So when we are going to raise funds from a VC, you should ideally look at what stages they are investing in, what is their investment thesis. Investment thesis is their set of rules they have basically. So, like I said, only energy tech companies, only companies who are making more than a crore a year. So this is called the thesis of a VC. Right. Every VC has an investment thesis.
Okay.
Uh, yeah, so this is how the VC invests in such companies. This is the math that goes inside their mind. I mean, the math is even more complicated, but at the base, this is what they're looking for. I'll give you $100,000. How much can you give back to me, and how fast can you give back to me? Let's say I give you $100,000, and you're telling that I'll give back to you $1 million, but I'll take 15 years to give it back to you. That is not possible because this guy has to give it back to the LP in 10 years. So that is the scenario of how the VC ecosystem works and what they actually do, what their job is. And so how VC makes money is another question. So basically, let's say you're a VC, you have $100 million in your bank account from multiple people. You get two things. One is called a management fee, and one is called a carry. A
Okay.
management fee is a percentage of the total amount of money. Let's say $100 million, you get X percentage of the $100 million every year to manage your expenses. In that, you can hire a team, you can travel across the world to meet startups, you can run mixers, programs, events, all those things, whatever you want. You will get X percentage of money from the $100 million every year. And this covers your salary, everything for the next 10 years. After 10 years, once the VC gives the returns to all those investors who has invested in him, he would get something called as a carry. That is an X percentage of the total profits that he's giving out to all the people. Let's say he's giving you invested 100 million, he's giving out 500 million back to all the people. He will get some percentage of that profits as a reward, kind of like a reward. Yeah. So no, VCs
So,
also make.
making into deep, just splitting down and bifurcating it, where are the parts that a VC get amount from? Is it from family offices, and what are the other categories that a VC gets from?
Sure. Okay. So let's say you want to become a VC, right? How do you go on about raising money for your fund? So that is the most difficult part of being a whole VC. All the glitz and glam that comes other than that is secondary. So you are always accountable to your LPs. Number one is you fix a thesis, right? You fix where am I going to invest, how much am I going to invest, what is going to be the check size, and what is going to be the stage of startups I'm going to invest in. Am I going to invest in idea stage, MVP stage, early traction, growth stage, or late stage, above Series A, B, C, right? So you fix that. And let's say now you're going to invest in sports tech alone, right? That is a specific sector. Why are you going to invest is the first question. Maybe you have experience, maybe you're a sports person, maybe you're an athlete or something. You have experience or you worked with Adidas or Nike or someone in the past and you did operations for them or something, whatever, right? So what is your expertise in that area? And then what happens is you go out to specific people who are interested in that segment first. They are the first people you approach. So when it comes to sports tech, you go to all the major athletes, you go to all the major cricketers, you go and ask them for a couple of crores. First, you give me 10 crores, I'll give it back to you 30 crores. Of course, it will increase their PR also. Virat Kohli invested in this particular startup focusing on this particular technology. It's a good PR for Virat Kohli. So the first step is to go into all these people who are specific to your niche. If you are if you are investing in AI, probably go to all the AI tech companies that are large in India. Probably go to all the major tech companies in India. Go to Sridhar Vemu from Zoho, or Zoho would probably have an investment fund that they are looking to invest in SaaS companies. So what happens is this is also a scenario, right? Zoho would have a fund that they will be willing to invest in startups, which they can acquire in the future. Let's say Zoho has multiple things. Zoho has Zoho Books, Zoho Meet, and all those things. Let's say someone is building, let's say, AI-based lead generation as a Microsoft product. Zoho would invest money in that company, watch it grow. If it grows good, they would acquire that company and add it as a suite of products in Zoho. This is their strategy. So you will have to think from their perspective also. So if this person puts money, what are the advantages he has? So and you would go to these companies and you would try to raise funds from them. And once you do all these things and you're not able to raise funds or you want more money, then you go to family offices. Family offices are basically, let's say there is a traditional business, Chennai Silks, Saravana stores. These are all traditional business. They make multiple millions in revenue every year. So what they will have is they will not invest in mutual funds or stock market or something like us using Zero or something. They'll set up a separate business. They'll hire a bunch of experts and they will give them the money that they're looking to invest and ask them to invest representing the family of Saravana stores. So what you can do is you can go to the family office of Saravana stores and you can tell them, I'm going to invest in this particular segment, and this is my expertise in this segment. So can you please give me 10 crores from your total pool of investments? When you're talking about Saravana stores, they'll probably be investing hundreds of crore every year. So you asking them 10 crores to invest in this thing is not a big deal for them. But the point is they should trust you. Why would they trust you is your experience and what you bring into the table and how you are going to contribute it to them. So this is what you actually do. And then let's say you're raising a late stage fund, you go to yeah, next you go to is Middle East and Southeast Asian markets. Where do you have family offices who are capable of putting huge checks? So if you go to Middle East, the minimum check is $1 million. I mean, you get
Okay.
lesser checks also. But yeah, this is what you do. You go to family offices abroad, and when you're raising a large fund, you go to endowment fund. So SBI will have, let's say, the mutual fund portfolio. You can raise money from them also, and not just mutual fund. They'll have other portfolios that has a lot of cash, which they're looking to invest something so that they can get returns. So you can go to endowment funds and banks, and also you can raise funds.
Perfect, Nitish. Perfect. So we have spoken a lot about investments, right? I want to jump into startups. Okay.
Yes.
So being an investor, being an VP in investments, I want to know first starting with a pitch deck. Okay. How should a pitch deck be, and what are the common mistakes that a startup founder that you meet in day to day is making a mistake in the pitch deck?
See, I look at a minimum of 40 to 50 pitch decks a week. Right. I mean, I used to look a lot more at the early stages of my career, but yeah, now at least 30 to 40 pitch decks a week. So it's very simple to make a pitch deck. A lot of people, a lot of early stage startups, the mistake that they do is they try to cram in as much information as possible into a single deck. Right. When you are pitching to an investor or a VC, and if they have a little bit idea of what this particular industry is and this particular business is, a 30-second glance at your pitch deck is enough for them to understand what exactly you're doing. Right. We see ideally, or let's say any investor, right? 1 minute is all the time you have to convince them to invest in your company. I mean, with your pitch deck, basically. So let's say I get a deck. The first thing I want to see is the name of your company, very clear. I want to know about your team, exactly who are the founders, what are their pedigrees, and what are their credentials, what are the experience they have. Next is the problem statement you're solving, solution. So now you covered 4 slides, right? See, market size is a slide that a lot of people ask to put in the pitch decks. But I personally don't see look at the market size slide very much because you never know the backup of the numbers. You can put it's a $10 billion market, but what is the, you know, if you talk about, okay, let's say cabs, right? When talking about cab aggregation, you know it's a huge market. That is all you want to know. You don't want to know how big the market is and what is your TAM, SAM, SOM. It is required, but it is not a very big priority. Right.
Okay.
Now, once you talk about your solution, now go to how exactly are you solving the problem. I want to know the exact business model and your revenue streams. How are you making money out of this business model, right? Maybe put a flow chart or something for both business model and revenue models. Explain me clearly on how what is your unique stuff that you're doing. Probably a comparison is also good. So you can compare what exactly the current startups are doing and what you're doing differently in the space. And once you do that, the main slide is numbers, right? I want to see numbers. What is your traction? See, you can pitch, talk to me about anything. You can tell, I'm going to create a new ride hailing app that is going to revolutionize the world. But show me the proof, right? What is the number? It need not just be money, right? It need not just be revenues and everything. If you're an early stage startup, I want to see traction. See, a lot of people, a lot of startups that are in the early stage that try to raise funds, they come without numbers. Right? They have an idea. Idea might be superb. The founders might be amazing in what they do. They might be the best coders in the world. But some people would put money in them, but most people would not put money in them because most people look at numbers. Numbers are the biggest hook in the world. So, what I would personally suggest is whatever you're building, just build a simple website. Use no code, use WordPress, use Wix, whatever you want. Build a simple landing page. Talk about your idea in that page, and let's say just put a what do you say wait list, right? A wait list form, name, email, phone number, telling that I'm interested in this product and add yourself to the wait list. It can be any product. You can build an electric bicycle, you can build a email tool, or you can build a WhatsApp bot, whatever. Just put a landing page, add a wait list. I don't care what you do. You can give it to your friends. You can give it, float it around in your college. You can run a ad or whatever. Do whatever you want. Show me numbers on the wait list. It's a very simple and effective way to hook a VC into giving you money. You need not even build the product. Just build a landing page with, let's say, 5,000 people on the wait list. So 1,000 people on the wait list, right? I would be, let's say, the percentage of the chances of you convincing me without this particular traction numbers versus the percentage of you convincing me with this number is way higher. Right, I'd be so happy to see that, yeah, these guys have an idea, but a lot of people are interested in the idea. So probably tomorrow when they launch a product, these people, let's say even 20% of these people are buying the product. It's a very good trust for me, right, to put money in your company. So this is what I want to see it, as a major slide. Traction. If you're making revenue, well and good, put the revenue numbers. If you're making, let's say, see, there are two things here, right? When you're an idea stage and you're growing slowly, when you're in your early stage of your revenue, probably making 1 lakh, or let's say 10,000 a month, right? These are very early stages, but you have 5,000 customers, 10,000 customers, but few of them are paying you and you're making 10,000 a month. Uh, so in this case, I would say you focus on the larger number. I put both of these things, but the focus on the slide should be whichever number is the largest. 10,000 users. Put we have been able to achieve 10,000 users in the last 6 months of our launch. And bottom somewhere put the current revenue is 10,000 MRR, monthly recurring revenue. Or let's say
Okay.
you have 10 customers and you're making 10 lakhs a month. Put MRR 10 lakhs as the focal point and bottom put current customers 10 and projection of how it's going to grow in the coming months. So this is how you design the traction slide. So this
That's
hooks the
nice.
people. Yeah, this hooks the investors into your pitch deck. And next is what is your plan? What is your projection? Talk about how you're going to grow this, any future product launches, when are you going to launch it, if you can link a demo to it, well and good. And then next is what do you call it? Yeah, the main slide. How much are you looking to raise? At what valuation? So this
Okay.
is a very important slide. So you should be very clear on the number. You can't be like, yeah, somewhere around 100,000 to 200,000. I'm not sure on the valuation. Don't be like that. Just tell a number. Tell I'm going to raise 100,000 or tell I'm going to raise 200,000. See, it is very hard to figure out the valuation at a very early stage, right? You need something to back up your valuation. So for that, again, come back to the traction slide. Tell I have 10,000 people on my wait list. So my valuation is X amount of money. Or let's say if you don't have any sort of traction or any sort of validation to your idea, how would you decide a valuation? Yeah, I mean, you can go always go with the safe note method, but that is too complicated for what early stage companies are doing right now. But yes, show some traction, fix up a valuation, and start. Or initially, when you're raising funds from an angel or something, don't worry about the valuation. But just don't give too much equity. But yeah, don't worry about the valuation. Whatever valuation, take the money, build the product, and next round you can worry about the valuation. How much are you raising? What is the valuation? And where are you going to use this money? So this is
Right.
exactly what we
So
want to do with this slide. Yeah.
So coming up with this, I just want to ask you if I'm being a startup at a real estate startup. Okay, so splitting up the equity is very crucial thing here, right? That decides up the entire valuation of my company. So
Yes.
being a founder, let me keep myself as an AI. I'm having an AI SaaS product or something. I want to
Hmm.
put myself inside the market. I'm coming for an VC, seeking for an investment. Okay, so let's say if I'm in seek of $100 million just for building my company, what equity should I mean, how should I find my valuation? How should I set my equity that I should give to the VC?
Okay. Nobody is going to give you $100 million as the first check. That is point number one.
Yeah,
Okay, so
no,
let's say,
it's just like
yeah,
maybe series A or
let's say,
B. Yeah,
yeah, okay. No, when you're going to series A or B, evaluation is decided, right? You have a concept
yeah,
of evaluation and pre-money valuation, and at that point of time, you're decided. I mean, once you cross seed stage, your valuation is fixed. Right, it's very easy to calculate valuation. You go to ADCA and you're sorted with valuation. But the problem happens when you are a very early stage company. You're trying to raise your first check, right? Uh, yeah. So when you're ready to raise your first check, you go to an angel. So now it depends on who you're going to. So let's say you're building a AI company and you're raising funds from, let's say, Sam Altman. Sam Altman is like, yeah, boss, I'll give you $100,000. I want 20% of your company. Now there is no valuation here. Right. He's just
okay,
asking, you don't talk about valuation in your first check. You talk about how much percentage are you willing to give up. Then in the next step, in the next stage, you can talk about valuation. Yeah, last round I gave this much for this much. So my valuation is this. First round is all about percentage.
okay,
So when Sam Altman asks you 20% for helping, I mean, investing in your company for $100,000, you have to look at the strategic value he brings. At the end of the day, he's Sam Altman, right? The amount of connection he's having in the AI industry, nobody can give it to you. Whatever you do, nobody can give it to you. And I mean, he owns ChatGPT, so the level of research they're doing in the LLM space is what he you can look at it firsthand and you can grow your company with that. So now it's your call to decide if you want to dilute 20% of your company that you are going to build. He is not going to build anything. He is not going to sit and code for you. He will probably give you 2 hours of in a week. That is best case scenario. What I'm talking about is he will probably give you 2 hours a week, or maximum ideally he would give you 1 hour a month or something. Right. So it is up to you to decide whether it is viable to take him into your company at 20% and give him 20%, and you have to make sure that he is contributing 20% to your company. Let us say you strike out a deal with him, and let's say you are building a wrapper on top of the GPT-4 algorithms, right? So let's say you strike out a deal with him, telling that, yeah, I'll give you 20%, but I want GPT-4, what do you call it? GPT-4 API access for free for the rest of our lives. This company will never pay for it. Tomorrow you can rake up bills in $500,000 range per month, and you don't have to pay. If you are able to strike out a deal like that and give him 20%, yeah, it makes sense. But that would not happen. But yeah, it makes sense, right? So it is the same with everyone. Any angel you go to, what is the percentage? So let's say this particular angel has nothing to contribute, or I mean, not nothing to contribute. Probably he's not Sam Altman, but he is a Series A entrepreneur with an AI company. Someone from Chennai, he's having a Series A company. He has good money. He's really good money, but he has good connects in India and Chennai, and he's willing to invest in a company. What I would suggest is don't go above 6%. Depends on the situation. When let's say 10 people are able to give you money and you have to select one out of 10 people, then don't go about 6%.
Okay.
If let's say there is only one person who's asking you 10%, and if that person is not putting you money, if that person is not going to put money, your company goes down and you're going to shut the company, yeah, you don't have a choice. Take the 10%. You can't
Yes.
negotiate much.
We don't
But
have an option to.
yes, but what I would say is that even if you're giving 10% and you don't have a choice, try to expand the circle. Like in negotiation, you have this concept of expanding the benefits, right? Uh, Apart from money, try to get something that has very little value for him but has a huge value for you, person his company. Let's say he's Series A startup. Let's say you want connections to this particular VCs and this particular companies in the future. Tell him upfront, I want this particular I want you to connect me with this particular VCs for my future runs. I want you to give me connections to these particular startups or these particular companies or this particular person. I want you to give me connections to government grants and all those things. And that is not going to make much, that is not going to cost him anything, right? It's just his connection. You want to make a phone call and connect you with that particular person. So in that case, you can raise funds from such people. So what I would say is that you can also raise funds from VCs.
Okay.
VCs in the sense, not VC companies, venture capital people who are working, let's say VPs or partners in a VC firm. They personally would have money to invest in startups, right? You can go to them and ask them for investment personally in a very early stage company. Let's say you're going to a VP or a partner in Sequoia. Sequoia does not put money in early stage; they put in above Series A, right? But those partners would have money to invest in such startups. When you're getting money from them, you can ask them, "You're investing in me. I'm ready to give you whatever percentage you ask, but I also want you to help me with fundraising in future rounds." Since they are the partner at Sequoia or the VP at Sequoia, they would have a lot of connections in every single VC in the country. Right. So they can easily help you to raise future rounds.
Yeah.
This is
It
how
will be
you
better
have
for us to
to,
get connections.
yes, exactly. This is how you
Yes.
leverage your percentage of equity. Leverage it as much as possible.
So let me consider if I'm having a product. So mostly when it comes for an investment, there is a important factor that to be considered is a product market fit, right? So now I'm coming with a every project cannot become a product for a customer, right? So if I'm having a project, if I'm building a project in my college days, consider me as a 17-year-old boy going to a college or a diploma. I'm creating some project in the level, and I'm want to take that project into a product for a customer. I have to build a startup from that. So, in your perspective, how should I find is the product market fit?
Perfect. See, if you want to figure out the product market fit, let's go back to the traction slide I was talking about, right? One,
Yeah.
the best way to, okay, let's come from step by step, right? The first step you do is look if there are other companies in the market that are doing something similar to what you're doing. Let's say you want to build a ride hailing app. If
Okay.
you want to build a ride hailing app, of course there is product market fit because there is Ola, Uber in the market. So you don't have to worry about that. But if you're innovating something on it, let's say you're bringing subscription based ride hailing app. So the first thing that you have to do to figure out product market fit, if you're building something, okay, there are two kinds of startups, right? Someone is building something that is entirely online. It's a SaaS product. Someone who's going to build something that has a consumer touch to it, probably a fashion brand or a food or a D2C brand, something that is related to consumers. So first, let's talk about SaaS companies. So when you're building SaaS companies, any sort of app, application, AI, whatever you build, to figure out the product market fit, the first thing you have to do is test out with a bunch of people. Don't launch it. Test it out with 10 people at first. You want to build a ride hailing app? Go and talk to 10 Ola drivers. Take Ola cabs. Talk to 10 drivers. See what they're talking about. Uh, so simple. Just ask them how is it going for you? How is Ola? If you don't want to reveal much about it, just tell them I'm planning to drive Ola. How is the commission system? 2 minutes into it, they'll start spilling out all the secrets about Ola. Right? They'll tell how bad the commission system is, what are the problem statements, and you can even ask them the solution. Tell them, எப்படி இருந்தா உங்களுக்கு கரெக்டா இருக்கும் அப்படின்னு நினைக்கிறீங்க அப்படின்னு நீங்க கேட்டீங்கன்னா themselves still tell it. இப்படி இருந்தா நல்லா இருக்கும்பா.
Yeah.
இந்த மாதிரி கமிஷன் வாங்காம மாச கடைசியில வாங்கினா நல்லா இருக்கும். மாச ஸ்டார்டிங்ல வாங்கினா நல்லா இருக்கும். They themselves will tell what exactly the solution is. So now what you can do is you can also tell them that ஆனா நான் இந்த மாதிரி ஒன்று ஆரம்பிக்கலான்னு இருக்கேன். இந்த மாதிரி நான் ஒரு கம்பெனி ஒர்க் யூ ஒன்ட் டெல் தட் யூ கேன் டெல் திஸ். ஆனால் இந்த மாதிரி கம்பெனியில் ஒர்க் பண்றேன். எங்க கம்பெனி இந்த மாதிரி ஒரு ஆப் பண்ணிக்கிட்டு இருக்கோம். இந்த மாதிரி உங்களுக்கு இந்த மாதிரி டிரைவர்ஸ்க்கு இந்த மாதிரி ஆப் பண்றோம். உங்களுக்கு இது ஓகேவா அப்படின்னு கேட்டோம்னா இது சரி வராதுப்பா. இந்த பிரச்சனை வரும். They also will tell. Or let's say you're building something else. Let's say you are building an accounting tool, right? It's a SaaS
Okay.
product for accounting. You go into CA companies. There are a lot of CA practices in Chennai. Go into any of those. Tell them you want to meet the main person, or if you are very socially awkward to do this, connect with them on LinkedIn.
Okay.
Ask them, can I have 10 minutes of your time? I want to talk to you about something that I'm building. I would really appreciate it. Connect with 100 people, 10 people would reply. This is the ratio 100 people, 10 people will reply. 10 people, out of which 5 people will agree for a meeting. Talk to those 5 people, tell them what exactly you're doing. They'll never steal your idea. Nobody can steal your idea. That is the thumb rule of building a startup. I've seen a lot of founders, right? Even to me, they are very hesitant to reveal what their idea is. They're like, "So it's very secret. It's a patent. They're trying to patent it and all those things." Boss, nobody can steal your idea. I can copy your idea and do something. I'm 100% sure I'll pay. Right? Because if you are building something, it is out of the problem that you face. You are the only person who knows what exactly that problem is. If you're building an accounting tool, you're probably an accountant. You work with Tally or something and you face the problem. So you're building this. I don't know what Tally is. I can copy your idea, but I'll probably fail in the next 2 3 months. That is the thumb rule. I don't know how it works. There is no logic behind it, but this is nature of building an idea. So you once you talk to these five people, ask their feedback, build on top of it, keep building till one, let's say out of the five people, three people say it's perfect, it's very good, I'll buy it. Then you have figured out the product market fit for your idea. This is
Okay.
one way, and next way is to again build a landing page, run ads, see if people are applying for the wait list. Right? 10
This
to
will be the second method.
yeah, that is the easiest way. Run ads and show what exactly your product is, and try to raise not raise. I mean, say yeah, try to raise interest for a product. That is again product market fit. And there are a lot of crowdfunding platforms. This is the worst case. Don't go there, but it's too complicated. But if you don't have any other option, go here. There are a lot of crowdfunding platforms where you can go and put your idea, and people would invest in your idea. Let's say you're building headphones, right? You're building very innovative headphones. You can put about your idea, and people would pay for your headphones before you even build your company. Right? Let's say your headphones cost you 15,000 rupees. You can tell we can pay 6,000 rupees now, and once I build the product, I'll send it out to you for 6,000 rupees instead of 15,000 rupees. So a lot of people have built very successful companies using this model.
Okay.
Right. So this is one thing. And now, if you want to build a consumer-centric platform, fashion or food, see your first product market fit is going to be your family and friends. You're building, let's say, healthy chocolates, fat-free chocolates. First, go and give it to your friends. Ask them to taste it. See if they like it. See, most of them would say super because they're friends or family. You go and give it to your mother. If it tastes like the worst chocolate in the world, she'll probably say இந்த மாதிரி நான் சாப்பிட்டதே இல்லை சூப்பரா இருக்கு. That is not what you want. You want harsh
Yes.
criticisms, at least for the early days of your company. So go and give it to the public. Stand in the road, take 10 pieces of your dress. Let's say you're building a baby clothing company. Hey, go outside a hospital. There'll be new mothers coming in. Give it to them. Tell them, give it to them for free. Right? Tell them this is a new product. Use it. See if you like it. Just I'll call you after 5 days. Tell me if you like it. If you don't like it, you tell me. You keep it. Right? Spend some money on it. Give it to a couple of people. Take their feedback. Reiterate. Rework, and then one day you will get the perfect product. That
Yeah.
is when you launch. That is when you exactly launch.
Perfect. So moving on, I want to know what industry, what sector of the industry is the investments focused on. Let me say, if I'm giving you 1 crore in your hand and you want to invest it in some sector of the company, in what sector are you investing right now? What is the emerging sector that is going on right now?
Very good. So if you give me 1 crore, first I would focus in India right now as consumer.
Okay.
A lot of people would be hesitant towards that because see, one thing that we have in India is consumers. You have 1 billion people, right? All of them are consumers. They're going to buy something or the other every day for their survival. It can be milk, it can be TV, it can be a car, it can be some people even buy helicopters, right? It's up to their what they're doing. Consumers, right? You build something for consumers that they want, not what you want to give. Um, if you look at Southeast Asian countries and China is having a very similar population to us. They are focusing big on consumer-centric startups,
Right.
live streaming technology. So you have a lot of people who use TikTok to sell products on live streams. Huge. It's very huge there. But in India, we are yet to see it. But I don't know if a lot of people know this, but if you look at any of your people who are above 40, their Facebook accounts, let's say mostly people who are, women who are above 40, you look at their Facebook account, you can see a lot of people doing live streams selling saris from Rajasthan, from Salem, all those people. You see, we are sitting here talking about deep tech e-commerce. building AI-based products, this, that, virtual try-on, this, that, and everything. You're probably making 1 lakh a month maximum as revenue. There is some guy in Salem sitting, having his own sari store. He's doing nothing. He is opening Facebook Live. He's showing all the saris, telling the rates. People on the chats are rushing to buy it. That is consumer. That is a startup. That is the perfect product market fit. That is everything you want. But he doesn't know two things about startup. He doesn't know anything. He does not want to raise anything. He makes good money with Facebook and live streaming. Right. China has been successful in bringing that market to Main Street, bringing it to the mobiles of a 20-year-old youngster. Right. That is what you want. That is what is going to grow in India. So consumer tech is huge. See, next thing is D2C brands. You have a lot of D2C brands in India right now. Food, clothing, fashion, this, that. Everyone is starting a D2C brand. See, what I see is that it's probably going to be like a bubble that is going to burst. Starting a D2C brand is very easy. Anyone can start a D2C brand. Let's say your mom cooks very good chips, potato chips, right? You like it, it's better than Lays. Tomorrow you can go to Upwork or Fiverr, connect with some good designers, build packaging and sell online and you're done. You make good money. All D2C brands that we deal with have very, very good revenue. But the problem is it's all online. Who is the biggest D2C brand? Who is the biggest consumer brand in India? ITC, Unilever, all those guys, right? They are selling very less. Their majority of the revenue is coming from offline stores. How are we going to build offline stores is the biggest system. Offline distribution. If you're a D2C brand, you have to focus on offline distribution. So recently we invested in a company. They're into pulses, grains, and all those things. So what he's doing is very good packaging, pulses, grains, millets, like similar to ITC, right? He's only selling in tier 3, tier 4 cities and tier 2, tier 3, tier 4 cities stores offline. Very small
Okay.
percentage of revenue is coming from online. How? Distribution. He is able to build a very good distribution network. So that is what a lot of D2C brands are failing to do so. So if a brand is having a very good distribution network and is having a very good roadmap to go offline, I would probably invest in that. Second, third is agri-tech. See, again, from our childhood, we have always studied agri-tech. Actually, agriculture is the backbone of our country. There is that huge market, but no one is solving for it. See, you can see a lot of agri-tech startups in the country, but all of them are focusing on people with, let's say you have over 10,000 acres of land, 100 acres of land. You want fertilizer in drones or you want satellite based crop mapping or something. So many companies are doing all these things. But that is a market, but it is not a large market. The largest market is farmers with 1 acre or under 1 acre or all those things. If someone is able to solve a solution, who is able to come up with a solution that solves this particular problem, solving a particular problem for farmers who have very small lands, and this particular solution is able to increase their revenue multifolds. That is the solution that is going to be successful. There are already a few companies in India who are doing it, but not as much as you want because the market is huge, supply is huge, and I mean the demand is huge and the supply is less for such startups. So when anyone is working on such solution, yeah, I would probably invest in that. And yeah, fourth, again, deep tech. You have very good talent pool in India who are amazing coders. We can build deep tech products. For India, I would say I would advise on it. Build products for the world. Right. If you're able to build a product and sell it in India, you can sell it anywhere in the world. That is the thumb rule.
Okay.
Right? Sell it in any Southeast Asian country and you can sell it anywhere. But one problem that I see is that a lot of startups are trying to build products for India, only for India. See, because you have 1 billion people doesn't mean the world only has 1 billion people. The world has more than 8 billion people. Right? You have to build for the world. Then, yeah, your advantage is India. Just because you are in India, you can easily sell it to 1 billion people, but it does not end there. You have to build it for the world. So that is one of the problems. So let's think very few companies in India are building for the world. Zoho, Freshworks, these people are not focused on Indianizing technology. They're not building a CRM tool for India. They're building a CRM tool based out of India. It can be used by anyone in the world. So uh, see, again, I would say there's this thing called Krutrim, right? Ola is building a chat GPT for India.
Yeah.
See, I know what they are doing, but internally they are building it for their internal use. They want to put it in all the scooters and everything and use it. That is their main thing. But let's say someone wants to build a chat GPT for India. Nobody is going to use it. Yeah, probably out of the initial virality, some people use it, but no one use it because nobody cares. Nationalism and patriotism or something, that is not how you sell products. It's only up to an extent. Right? Yeah, of course, I will be very happy to support you. But what are you offering that is unique from ChatGPT? It's something
Yeah.
that you have to answer. So, uh, again, when we're talking about Tamil Nadu, right? A lot of startups in Tamil Nadu are building products for Tamil Nadu, right? So if you see in the funding scenario, in the startup funding scenario, very few Tamil Nadu startups get funding from national VCs or international VCs, at least in the early stage, because you're building most of the product people are building products for Tamil Nadu alone. See, I'm not trying to be very political here, but it could be because of the language barrier or something. If you go to north, you see a lot of people building products for across the country. In, of course, in Chennai, you have in Tamil Nadu, you have so many people building for the country also. But I'm saying everyone should focus across the country. Build for the country, don't build for your specific state. Again, if you're building for the country, don't build for the country. Build for the world. It depends, right? So that is what you want to focus on. So I've had startups who are focusing on last mile delivery. I asked how are you different? Boss, they say we are doing it in Trichy, we are doing it in Salem, we are doing it in Erode. Yeah, you're doing it in Erode. I'll give you money now. What is the next step? How are you going to increase it? What is your expertise in some tier three village in Andhra? What is your expertise in some tier four village in Uttar Pradesh? Right. How are you going to do that? It's very hard to do that. That is what I'm saying. You can't do it. You can't build a product focusing on a specific niche. If you're building a product, it has to be applicable everywhere. It has to be
Okay.
applicable in India. It has to be applicable in some tier three village in Indonesia also. That is how you have to build it. So if someone is building there, I would focus on that also.
So speaking on taking to the worldwide, if I'm having some industry running out of Tamil Nadu, okay, let me design some dresses or thing. Give me some tips that I take my product worldwide. So exporting out of India. So what are the tips that I can take it outside?
Good. So see, let's say you're building a D2C fashion brand, right?
Okay.
Uh, See, when you're building a fashion brand, you have to have an identity behind it. What are the most successful fashion brands, right? You take Louis Vuitton, you take Gucci, you take all these, you maybe Lorefina, all these larger brands. What makes them unique is that they have an identity. They have that cultural factor behind them.
Okay.
You tell that where is Louis Vuitton based from? I think Italy. I'm not sure. Probably Italy, right? Uh, so when you take Louis Vuitton, they are one of the largest luxury brands in the world. Why do people buy that? One is it's viral, and a lot of it's expensive, so it's status symbol and all those things. But the factor is that they portray themselves as they are building. something out of some very high quality leather in Italy. To get the leather, they're probably feeding the cow with some natural grass or blah blah blah. 90% of it would be like, right. You never know. Probably they're building it out of Tirupur. That could be the scenario. But it's the picture they take. It's the picture they talk about, right? So when you're building a D2C brand when you're building a fashion brand in India, I would suggest put a story behind it, right? A story that is applicable worldwide. So one of the most successful fashion brands out of India is Sabyasachi. Why is Sabyasachi famous? It's because of the design, because of the cultural design. It's ingrained with Indian values and Indian culture. So it is, I mean, we're used to it, right? We are used to seeing saris everywhere. But when you talk about from the perspective of a foreign person, when you're talking about an American or a European, it is exotic for them.
Yeah.
Similarly, how Louis Vuitton is for us. You're sitting in
Yeah.
Chennai and we're talking about Italian leather. Whoa, Italian leather is something unique, right, for us. But someone in Italy might not even care about it. It's vice versa, right? When you're building brand forward, you have to build a story behind it. Or if you don't want to build Sabyasachi and you want to build a fast fashion brand, right? The most successful one right now in India is Switch. Switch is very successful with what the fashion brand that they have built. They have built a very good offline presence, online presence. Why is it good? They have a good casual formals. They have a very modern look. They have a very good streetwear. They're targeting youngsters in Bangalore who are looking to buy something fun at the same time comfortable at the same time formal. All those things. So the target people the people you target should be worldwide. That kind of people
Okay.
should be everywhere. Right. Who is Sabyasachi targeting? Rich women who are planning to buy expensive clothes. You have rich women who are planning to buy expensive clothes everywhere in the world. Who is this targeting? Youngsters who want to dress something casual, formal, at the same time comfortable, and they are ready to spend up to 2000 rupees for a shirt. You have such people across the country, across the world. So this is how you decide your ideal customer persona, and you build a story around it that attracts these ideal customer people.
Okay.
So that is how you build such stuff. So decide who you're going to sell it to, see what attracts them, build a story around it. So that
Nice.
is one such thing when you're building a fashion brand. And what else? What else do you want? Would you want to know when you're, what other segment do you want to know how to build a global brand?
So I want to know now. We are having the startup which is building India. I want to know how to take it outside the India. I mean, what are the exporting sectors
Yeah,
there? Like
got
it
it.
might be Amazon sell to it might be Amazon Myntra, which is working inside India, also abroad, right? So how I take it outside? Now you said about making the product for worldwide, right? Similarly, I want to know I have made a product for worldwide. How do I export it? That is my
Okay,
next point.
got it. See, if you're building a tech company, nothing. You just put dollars on your website
Yeah.
and you are world right now. Okay. Uh, let's say you're building a product. Probably what? See, there are a lot of programs. See, when you're talking about startup, there are a lot of programs. There is this Indo-German program called, I think it's called GINSEP, or I'm not sure of it. I think it's called GINSEP. So there is the German Indo Exchange Startup Exchange Program. Yeah, German Indo Startup Exchange Program or something. So there, I'm giving as an example. So there, what you can do is you have an innovative startup in India. You see that this could be working in Germany also. So you can go there, you can pitch to them. They will take care of all your accommodation, everything. They will give you a couple of money to work out of Germany, build the product for Germany. So that is one way. Second is, of course, exporting the product to other countries. There is one such thing you have. You build a fashion brand here and you want to export it to let's say Thailand or somewhere. That comes under traditional business. You build a very good channel for Europeans or Americans to buy a product. You integrate their payment methods, probably Stripe or Molly. Molly is very good. So integrate Molly into your platform and create a channel for them to buy your product, run ads, and again, next part is sending your product to them. That is logistics. That comes into logistics. You have a lot of logistics partners. You have a lot of traders here and there. You can connect with them, and they will help you with taking care of all the supply chain. You probably have to give them a cut or money or something. But yeah, it's all about the ads, right? It's all about how you are portraying your product and how you are running your product with them. I mean, focus on social media. Social media is very good now. Build content around your product that reaches a global audience, and yeah, people would obviously want to buy. See, first start with people where Indians are, countries where Indians are. Again, it's very hard to get separated from Indians, right? When you are building a
Yeah.
product out of India and based out of India, probably I would suggest focus on Middle East first. Dubai or Saudi or Qatar, there are a lot of Malayalis and Indians and Hyderabadis. You have Indians from every state in the Gulf. You have people from UP, Bihar, Delhi, Punjab. You have South Indians from Kerala, Tamil Nadu, Karnataka, Hyderabad. Everyone is there. It's like a whole mixture of India. If you want to test it out abroad, go for Middle East and see how their response is, and it's easier, right? You can make a bunch of mistakes and nobody will mind. But
Okay.
shipping it to America or something, you can't make a lot of mistakes.
Definitely. So thank you, Nitish. Thank you for the great insight. Furthermore, I would like to know, uh, being a founder or being an entrepreneur, and having a startup, where do startups fail actually?
Okay.
Let's take some hotspot topics like Byju's that's going on right now. Where do
Yeah.
startups fail? Yeah.
Okay. Number one reason for failure is founder conflict.
Okay.
Right. Select When you're selecting the founder, it's like so. See, I would draw a parallel between startup and marriage. Right. Both are very similar. See, when you're marrying someone, you should be very careful with who the person is. So your life depends on the character of the person and what they're capable of. If you marry someone good, you're going to have a very happy life. If you marry someone bad, you're going to have a shitty life, and then you'll get frustrated and you will probably end up in divorce. Exactly what happens in startups. Depending who your co-founder is. So if you're getting a co-founder, you should find someone with complementary skills.
Okay.
You're handling code. If you're able to code very well, get someone who's very good at business. Right? He should be very good at sales. He should be good at marketing or something. See, when you're both very early stage founders, you don't have to be good at anything. Right? You should be able to push it out. That's it. You can learn everything and then see. Both of them are going to handle everything. You're going to
Yeah.
code sometime. He's going to code sometime. But each of them should be accountable to something. Something fails in code, you can't show hands. You should be able to tell who is accountable. One of the co-founders is accountable for code. If something fails in code, I'll ask questions to you. If there is sales is getting low, sales is dipping, who is accountable for it? One of the founders should be accountable for sales. So fix
Okay.
that accountability on day one. Boss, what are you going to handle? What am I going to handle? Both of us will support each other in what we do, but who's accountable for what? And both the founders should have complementary skills. If both are going to sit and code, who's going to handle sales? Today it will be good. He might be your best friend, but tomorrow when there is no sales, both of them would start pointing fingers at each other. You are supposed to handle sales. I am supposed to handle sales. That does not work. That is the reason for most failure of most startups. Founder conflict. Second is product market fit. You overestimate or underestimate the market, and you launch something that nobody needs. Let's say what electric cycles, right? or self-driving cars. Nobody needs in India. It's a
Definitely.
product for it's a product for US. So you have see in US if you take self-driving cars, drivers are starting to charge more than $100,000 a year right now for truck driving. In India, you can get a driver for 5,000 a month. You don't need it. The cost of you to run that self-driving is more expensive than hiring a driver. Until that cost is goes super high and drivers start charging 5 lakhs a month, you don't need self-driving in India. So let's say you're building self-driving for India. There's no way to see. I know a startup called Swayat Robotics.
Okay.
Amazing startup. They have built level 5 autonomy in self-driving. Right. If you can go and look at the website also, they have built a self-driving system on a Bolero, and it can drive on Indian roads. You know the colony roads where you have cars parked on both sides and you have to navigate like this. It can do self-driving over there, and you
Okay.
can it can do on Indian roads. So, but his focus is US. He's not building it for India. His focus he is building it for India. He's building it in India because if the car can drive in India, you can drive it anywhere in the world.
Anywhere. Definitely.
Yeah, but his focus is not India. That is how it should work. So overestimating and underestimating the market. See if people in India actually need what you're building. Electric cycles is an example. Nobody wants electric cycle here. You can one reason is weather. Right. In
Yeah.
sunny weather, in the July, May, you cannot drive anything. You cannot even drive bike. How how are you going to drive electric scooter cycles? Right. That is not what you want here. So that is one scenario. Second is hiding something or becoming selfish.
Okay.
Right. You should be able to handle money. It is the hardest part of running a business, especially when you're coming from a regular family or you're the first business person in your family. Right. If you're a first generation entrepreneur, you would not have seen big money. Maximum you would have seen, let's say, 10, 20, 30 lakhs in your family. That is the maximum money you have handled. It's very easy. Put it in stock market, mutual funds, you're sorted. Right. Once you receive the 1 crore or 10 crore check, you should know how to handle that money. How are you going to spend it? You should spend it in places where you have to spend. See, uh, people like us generally who come from middle class or something, we're very hesitant towards spending money. Right.
Yeah.
There are two extremes for this. Yeah, one is people who come from middle class. They don't spend money. Or I'm not saying middle class. I'm saying people who have not experienced money. Right. They don't spend on the necessities. Was we want a AWS subscription. They try to figure out ways to bypass it. Right.
To
It
find a
works.
different way where it is free.
Yeah. It's something that's free. Right. It works in some cases, but in some cases it backfires also. Right. The amount, see, always calculate your time value of money. The time
Okay.
you're spending to do a particular thing, is it actually worth it to, okay, let's say you're getting a salary of 1 lakh rupees and probably your hourly rate is 1,000 rupees and you spend 5 hours to save 2,000 rupees. It is not worth it.
Doesn't mean
Your,
doesn't.
yeah, it's not going to be worth it because you already lost 5,000 rupees in that time. So this is how you have to decide on where should I spend money and where I should not spend money. And the other extreme is that people who have seen good money, who have lived in luxury, right? Most of these people, most of the I mean, not most, very few founders, when they get big money, they get attracted by, this dream of a startup life. Fancy co-working spaces, fancy offices, fancy laptops, all those things you spend on team parties and everything, and you're done. Your money is gone. Your money is down the drain. Because initially, until you make good money, until you make more money than you can handle, work out of an apartment or do something, but don't overspend the money. So money
Okay.
management is very crucial, and that is also one of the reasons why most startups fail. And this is a very large factor, right? Once you are very bad at managing money, you're answerable to the VC, and you can't tell them that boss, we spent money on a Goa party. Now what you do? Now it falls like a domino. Now you try to change the books. You try to
Okay.
write it down as a separate expense. That leads to something bad in your books, and then that leads to something else, and that leads to something else, and at the end of the day, you're in a scenario like what is that? Go mechanic or something that failed recently, right? You end up there. By this sort of same thing, they spend too much money, hoping they would make money. COVID came and they failed. They couldn't make money, and they try to do right expenses or something else, and this that, and now they're answerable to the founders. I mean, to the VCs, right? What do we do with
Directors,
the
yeah.
money? Yeah. So that is the scenario. What you might think this is not easy, and one party not going to make much of a difference. This is the business expense. One will become 10, 10 will become 100, 100 will become 1,000, tomorrow the company is gone.
Sure.
So that is where you have to be careful. Always be upfront. Tell the VC, boss, I'm going to take my team to a party. Morale is very low in the company. I want to build morale. I'm doing a party. I'm going to spend this much. Negotiate on how much you're going to spend. Be very upfront, right? So it's about you convincing them.
Got it. So we have been seeing one phase of a startup where it fails, right? He's getting an investment and the startup fails actually. Behind the scenes, what happens to an investor who has invested in the startup?
If you are an angel, yeah, that is what. No? If you're two scenarios. One, if you're an angel. One, if you're an angel, yeah, you're not going to invest like your life savings into a startup. You're probably going to invest like 10% of your money into a startup. You have 1 crore, you're probably going to invest 10 lakhs. You still have 90 lakhs. You're not going to die. So, yes, you'll feel bad and all those things. You'll try your maximum to save the company. But as a VC, you don't care. I mean,
Okay.
you care to an extent, but not. See, one is that it's not your money. Uh, See, second is that VCs work in this formula 80-20 ratio. 20% of your portfolio of startups is going to give you 80% of your returns. See, when I'm telling that VCs do not care, it's not like you send them a mail that, boss, I'm closing the company, and like, yeah, take care, all the best, tata, bye bye. It's not going to be like that. But they'll try their best to save the company. But again, time value of money. Is the time I'm spending to save this company worth valuable as to investing in another company is what they calculate. And if yes, they will help you. If they're not, they're like, yeah, do whatever. See, the scenario is that $100 million, $80 million that, see, 80% of your company, we assume that 80% of the company is going to go to loss.
Okay.
20% of the company that you put in, 10 companies you put $100 million, 10, 10 million each. 8 companies will fail, 80 million down the lane, right? The 2 companies will become unicorn. The 10
Okay.
million will become, let's say, 200 million. So I invested 100 million, now I have 400 million. That is the logic. Now I
Got
made
it.
4x with 2 companies.
Yeah.
So this is the thumb rule of investing, right? If you are an angel also, if you're an angel, or if you are a VC, I mean VCs obviously have this, but if you're an angel looking to start your investment journey, what I would suggest is that if you have 10 lakhs, put 1 lakh in each company. Put 10 companies, right? 8 might fail, 2 might be successful, you'll make to 40 lakhs out of it. And so see, that is the basic thumb rule. And yeah,
So jumping back into the investments, what is the fund cycle or the exit period that you mentioned on the term sheet for a startup?
it depends on what stage you're investing, right? So if you are
Okay.
investing in let's say we have an angel network. So angel networks, how it works is that we have a network of high net worth individuals, basically people with some sort of money to invest in startups. It could be 10 lakhs, 20 lakhs. So in Beej network, our minimum investment starts at 5 lakhs.
Okay.
5 lakhs per startup as an individual investor if you want to invest. For startup, we invest anywhere between 50 lakhs to 4 crores as a total pool of money. So let's say you have 5 lakhs to invest. Uh, so what happens is we are investing in growth stage companies. So seed to pre-series A. So in these stages, we ideally take an exit in the next round or the round after.
Okay.
Because when you're going for a larger round, right, above Series A and Series B, startups don't want a lot of micro VCs or angels to be on the cap table. And because larger VCs also don't want them to be on the cap table, because for every single decision you have to go to them and get approvals. So they don't like that. So they don't want them to be on the cap table. So you probably, if you're investing in early stage, you would get an exit in Series A or Series B maximum as an individual investor. Very few startups allow you to be there till IPO.
Okay.
So, but maybe if you're an advisor or something, you can be there till IPO, but that is also a rare scenario. So, yeah, so what happens is the timeline would be, I would say, 2 to 3 years. You
Two
would
to three
probably,
years.
yeah, you would probably hope for an exit in 2 to 3 years. So, the startup that you're investing, it should raise another round in 2 to 3 years maximum. Some
What
startups,
about the early stage start? I mean, startups above Series A. What would be the exit
so
period?
see, startups above Series A investors who come in, they are not hoping for like next round exit. They are hoping for IPO,
Okay.
right?
Directly
So
IPO. There's no
yeah,
fixed term or tenure.
yeah, because above Series A, I mean Series A is also now everyone is coming in Series A, but
Hmm.
let's say Series B and above, right?
Okay.
Series B and above, the minimum check sizes start at 5 to 10 million minimum. So when you're putting 5 to 10 million, you're raising the next round. Your valuation is not going to increase by 2x. It's probably going to increase by 1.5 times.
Hmm.
Right. You're not there for 1.5x returns. You're there for 3, 4x returns. So in that case, you don't want. See, in that case, you don't want to put that much. You don't want to take a very quick exit. You want to take a. You want to wait for a longer period of time. So that is ideally what happens, right?
Nice.
So IPO is a very good option for. I mean, IPO is what late stage investors usually prefer.
Okay. Got it. Perfect, Nitish. So we have covered a lot about investments and where the startup should focus on getting an investments and every those cases. Thank you for your lot of insights that you have given. Finally, at the end of this, I would like to give you some tips for the new startup founders who are coming out of college, might be, or trying to build some new company with. Give me some tips for them where they should start and how they should manage their company in the early stages.
Yeah, sure. See, if you're a young entrepreneur with very less experience with this, but you have all you have is passion and you have an idea to build something. First, I would say is that find a mentor.
Okay.
Mentor can be anyone. Let's say I am also mentoring a bunch of startups, very early stage startups. If anyone is getting connect with me, or let's say if you are building something unique in a particular space, you're building something in the automotive space, right? I would suggest you connect with the top people in that particular industry using LinkedIn. Message 100 people. Let's say the VP operations of Ford, VP operations Mahindra, VP technology Mahindra or Suzuki or something. Connect with them on LinkedIn. Message 100 people. 10 would connect with you. Tell them, sir, I'm building this thing. I'm very passionate about this. I need 1 hour of your time for a very small meeting. Find a mentor, connect with them. See, once they like your idea, they will be very interested in helping you.
Okay.
So they would help you with building your idea. So that is one step one. Find a mentor uh, and network. Second best network. Network with as many people as possible. Go to all these startup events. See, if you're in Bangalore, well and good. You have hundreds and hundreds of startup mixers. If you are in Chennai, you have Tamilpreneur, You have SaaS Boomi, you have Idea Patrai, and you have a few other startup mixers that happen here and there. You have a lot of incubation centers that conduct mixers and everything. Network with as many people as possible. When you are an entrepreneur, your network is the only thing that matters. The number of people you know and their connections. So see, when it comes to networking, it's not you meeting one person, right? It's your network connecting with that person's network. That person might know CEO of Google. You never know. You are like one question away from it. Boss, can you connect me with Sundar Pichai? It could be a scenario. You never know. Right? So that is the power of networking. Network with as many people as possible. Go to events, attend events, learn as much as possible. And second is once you have a little bit of traction or once you figure out what you want to build, try to get incubated in a good
Okay.
incubation center, in a very good incubation center. See, if you are having a very good product, you'll try to get incubated in IT Madras research park or something. Best, it's one of the best. Uh, then you have a lot of incubation centers here and there who help you with all these people. Probably IIM incubation centers are very good. They open applications every year, look for it and apply. And so once you build a product using the incubation center, apply for accelerator programs. A lot of people have accelerator programs that help you reach your first customer, that help you give you connections, that help you network. So Beej Network is also coming up with an acceleration. We are launching an accelerator program with a Singapore-based company called Capita, where we are going to help startups reach their first customer, and we're going to provide them with multiple resources. So there are a lot of accelerator programs like this across the country. IITs and AIMs also conduct accelerator programs. Connect with them, try to get into an accelerator program, and reach your first customer. See, there are a lot of resources that are available to help you with the startup journey. Right.
Okay.
Identify those resources. It's very hard to identify when you're at an early stage when you have very less network, but identify them. And everyone is just one step away from helping you grow your company. Nobody wants to see you fail. Right? Everyone wants to help you. Reach out to them. Reach out to those people. Ask for help, and people will help. So that is one thing that you have to keep in mind while building a company as a student entrepreneur.
Got it.
Yes, it
Thank you,
takes time.
Nitish.
It takes time, but yeah, it will happen though.
Yeah, that's nice. So today in an episode, we have covered a lot about investments. In the first part, we spoke about the family investments and the LPs. We spoke about how the investments get, and literally we got some good knowledge about how to become an investor too. Then we spoke a lot about startups, where startups fail, where startups have to focus on. So today's section has been very insightful, Nitish. Thank you for your time that you have
Thank
given
you.
today. Thank you.
Thank you.